Hello, everyone. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. If you ask a question in the chat box, go ahead and leave your contact information as well. And if we're not able to get to your question, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our guests today. Mark Seither is a partner and wealth manager with Kingsview Partners in Knoxville, Tennessee. He has a Bachelor of Arts in Economics from San Diego State University and began working as a financial advisor for Northwestern Mutual in La Jolla. Mark enjoyed finding innovative solutions to clients' complex problems, and his desire to work with the entrepreneurial-minded helped him thrive as a financial advisor. As Mark honed his skills as an advisor and planner, he looked for a platform that would better pair with his desire to work with clients needing advanced planning and specialized fixes. He found a spot back in Northern California in early 2017 when he joined Trust CFO and assisted in integrating complex tax and estate planning with wealth and investment management. Since then, he has collaborated with Josh Saunders, a retired Navy and current Southwest pilot, to build Kingsview Partners. Together, they assist individuals on wealth management and tax strategies. Mark, I'm going to go ahead and let you come on and say hello and maybe give us a little transition into who our presenters are today.
Yes, thank you so much. Very excited for today's topic. My business partner and I, we always bring real estate into the equation when talking about wealth management. Not for everybody. Some people decide to go a different route, but one of the things that always comes up is people, they have a one-dimensional view of real estate. They think about being a landlord or, plumbing a tenant's toilet or something. And we have to remind them that real estate is a very large category, and in anything you need to get educated. You need some good guidance, and then you can start executing. And I think we have some absolutely fantastic educators on today. So very excited for today's webinar.
Thank you, Mark. I'm going to go ahead and introduce the team that is here today. Thank you, gentlemen, for taking time out of your day to be here. We are pleased to have the leadership team of JID Investments with us today. John Rubino, COO, founder and co-managing director, David Schatz, CFO and co-managing director, and David Rutherford, director of investor relations. Founded in 2013 and with offices in Fairfax County, Virginia, and Hilton Head, South Carolina, JID Investments is a real estate private money and equity investment firm which seeks to secure high yield returns with medium risk by providing investment capital to individuals and businesses with viable residential, commercial, and mixed use real estate business and or investment opportunities. JIDI currently has 19 million invested on 11 executing projects throughout the Mid-Atlantic and Southeast That would be Washington, D.C., Frederick, Maryland, Fairfax and Richmond, Virginia, Charlotte, North Carolina, and Atlanta, Georgia. JID's business strategy is designed to form long-lasting business relationships with developing to well-established companies. Their goal is to be an integral part of their clients' financial success by funding their ventures while earning their desired returns and continuously focusing on the growth of their business relationships. And I know we're going to hear from everyone that's on the call today, but John Rubino is going to go ahead and kick us off, and we're excited to have you present first.
Thank you, Marche. Thanks, Mark. It's great to be here. I speak for David and for Dave. We appreciate the opportunity to be on with the Advice Chaser team, your listeners. We've worked hard to put this together, and we really do appreciate you putting it together for us on the screen. And we welcome all those that are listening today. We encourage your participation with questions. And please feel free if there's something that you'd like explained a little bit more in depth, we're happy to do so. I'll lead a few of the initial slides, and then we'll have each member of our team jump on and capture various areas where they focus and have their expertise inside the company. So we do look forward to speaking with you today. And with that, we'll get started. So we focus, and in general, what we're going to talk about today is syndication or real estate investing when it comes to passive investing. And so the difference between being a passive real estate investor versus an active real estate investor is, as a passive investor, you're purely bringing in capital. You have resources involved that are purely passive in nature, where you are either a limited partner in a project or you're someone that is just basically a silent partner. And so you basically are able to be part of amazing real estate opportunities, but not have to worry about the day-to-day operations, being on scene, dealing with general contractors, banks, really being the point person, or what we call a sponsor in that scenario. But you're more of that person outside looking in. You're seeing your investment working in the projects. You're directly involved, possibly talking to a sponsor. But the way we do it is we're a facilitator, or we're the liaison between the investors who are part of our business and have joined us, to then partner together with our capital in the company to invest on a variety of different types of real estate investments, which we'll show you. So with the way we do it, we are working with both the sponsor, who's the active piece, and also the investor, who's the passive piece. In today's presentation, we will talk a little bit about how an investor can directly work with a sponsor. We'll talk a little bit about the pros and cons of that. And at the same time, hopefully give you some information that can help you as you make that decision as part of being a passive real estate investor. So we can go to the next slide. So a lot of people are asking, and they have asked over the last couple of years, why invest in real estate? Specifically right now, if I take a snapshot in time, I know we've had some challenges over the last few years with COVID. When it hit, the impacts of it, the duration of it, now kind of just the lasting effects of it as we now look at what the new norm is. But I think day to day, looking at what's happening both, geopolitically and the international stage, as well as nationally, we're seeing unprecedented things happening within our economy, ranging anywhere from inflation, supply chain issues, labor costs that are seeing record numbers, a stagflated type market with regards to the labor force. And we're also seeing challenges and risk inside the real estate market. I think everyone would agree that as a stock market investor, the worst word you could hear is probably volatility. And I think every day when we turn on our internet, or we go and look at television and look at the stock market, I think that word is pretty much the day-to-day word we're seeing right now with the stock market. So real estate is experiencing some challenges, I think, nationally, but when you look at specific markets and you look at certain areas that you can focus on, you can find some really fantastic markets inside the United States where real estate is flourishing. And so that's kind of what we focus on, and where we kind of tend to look at within our investments. And it's kind of like being a sniper rather than a shotgun shooter, where you're looking at specific markets that are really ideal for real estate investment right now. We do see growth in the markets we're in, and we can talk to that. And we also see those markets that we're kind of shying away from having some challenges. And probably as we potentially could see some further challenges in the economy, we feel we're in markets, and the markets we're going to talk about really have resiliency, and that's why we like to invest in those. But as a passive real estate investor, you're going to be looking at and being involved in investments. Again, as a person outside looking in, a lot of the folks we work with, ourselves too, as investors, we are passive, where we have our day-to-day jobs. Folks are going off and running companies. They have their patients or clients if they're dealing with specific occupations, and so they don't have the time to spend day to day on real estate investment. So this is why this is really unique. It's advantageous if you want to try to get into being a passive real estate investor, and has a lot of advantages, which we'll discuss throughout the presentation. You can go to the next slide. So, first thing you want to do is, and we talked about this before when we do webinars, is, how do you want to invest? What type of investor do you want to be? That's a definition. That's something you have to define for yourself. Some folks want to be active. Some folks want to buy property. They want to manage rental properties. They want to manage multifamily properties. They want to be directly involved. And those advantages obviously are you have control. You get to call the shots, and it's your project, your property. When you're a passive investor, you're giving up a lot of that control, those day-to-day decision-making processes, but you're also giving up a lot of liability, things like recourse debt, not having to personally guarantee loans on properties. Again, just dealing with the day-to-day headaches of managing a property, having a team where you have overhead and you have to pay for the experts that come in and are project managers or property managers or marketing and advertising teams. That's some of the things that you don't have to worry about being a passive investor. Now, I do want to reiterate, you do need to have an oversight. You still need to know how the operations are run. You need to understand how your returns are going to be made. What are the costs? Looking at the breakdowns, which we'll talk in the due diligence section of the presentation. But when you sit down, you really need to decide for yourself, hey, what do I want to invest in? And what type of projects do I want to focus on? And this is what we're going to cover in this slide is, do you want to be involved in projects that are development type projects, new construction projects? Do you want to be involved in value add projects where someone's going in, they're going to improve the status or condition of a property and bring in tenants to potentially rent for rental income? What's the type of profits do you want to make on a project? Do you want to make rental income, or do you want to make long-term capital gains? David's going to talk more about that from a tax perspective, but these are all the things I would recommend you sit down, you pull out a legal pad out, and you start writing down, because those are kind of the big things we look at when we look at a project: the sponsor, the location, the asset class, and really the returns are the big things. But as an investor, you have to decide, what do you want to invest in? Do you like student housing? Do you like senior living? Do you like storage? Do you like opportunity zone? And there's a plethora of information on the web, on the internet, that you can pull up. We tend to like to focus on development because of the fact that we see the higher yields on those projects. The advantages of that are, yes, great returns, but they could be a longer term period where you have your money invested 2, 3, 4 years. And if you're not looking at having your capital tied up for that long, then you may want to look at something that has some more cash flow, or something that gets your capital back in a shorter duration of time. The advantages of that is, like I stated there, but some of the disadvantages may be that your capital is only paying out a percentage of return that you could get in better returns in a higher yield type asset. So these are the different things. We're happy to help you anytime. There's also obviously registered investment advisors and folks that do this for a living, but we've done this now for 10 years, and we're happy to help you to go through this at any time if you'd like as well. We can go to the next slide. So with that, I'll turn it back over to Mark, who's going to have, I believe, Dave jump in and talk a little bit more about the types of investors that are involved in these types of investments.
Yeah, and I actually did. I was on mute there. I unmuted myself. I was going to add one thing just on that last slide, which is, as I mentioned in the beginning, sometimes people have a one-dimensional view of, investment real estate, and when they do start going down the subsets, we do encourage people to look at a certain asset class, the single family versus the multifamily, the commercial versus the opportunity zone. And if there's something they're not comfortable with, don't force it, right? Get good guidance, get good information, but there are some things where it might not be a good fit just personality wise and how you like projects run. Because we have run into some people who are like, well, I didn't like that, so I scrapped the whole real estate concept. Get good guidance, ask good questions, as well as, Dave is going to go into, there's, the two different types of investors, and there's different things available to each one. So Dave, could you shed some light just on the investor suitability for these two different types of investors?
Yeah, absolutely, Mark, and thanks for the introduction. Good afternoon, everyone. I just wanted to kind of briefly touch on the two different types of investors. As you guys are likely aware, the Securities and Exchange Commission, the SEC, is the government body that regulates all sorts of investments in securities, and they've identified two general categories of investors. Really, the biggest difference between the two being the financial position or financial status of the investor. The first one is an accredited investor. The second is a non-accredited investor. And if we can go to the next slide, we'll just kind of give a brief rundown of each of those two types. So accredited investors, it can be a person or an entity. You as an individual can invest, or we have folks who invest through entities, whether they're LLCs, they're partnerships, they're self-directed IRAs. So if you can invest as an individual, or you can invest as an entity or through an entity. Really, the biggest thing with accredited investors is you have to meet either an annual income requirement or a net worth income requirement. As you can see, the annual income is you must meet or exceed $200,000 for an individual, $300,000 for joint income for the past 2 years, with the expectation of that income level is going to continue for the foreseeable future. You can also meet accredited investor status through a net worth. You must have a minimum net worth of $1 million, not including the equity in your primary home. So if you have investment properties, you have cash, you have certain investments set aside, all of that can be used to meet the accredited investor status, just not the equity in your primary home. Why does the SEC define accredited versus not accredited investors? Well, because one of the primary responsibilities of the SEC is to kind of afford protections to investors. Companies are required to put forth annual statements, 10Ks, things like that, in order to be as transparent as possible with the general public and for those people who may choose to invest in their companies or their particular type of investments. Accredited investors, through their amassing of net worth or high income, they don't necessarily need the protections afforded by the SEC and other entities, so they are allowed to invest in securities that may not be available to non-accredited investors. These include such things such as unregistered security. Now, moving on to the next slide, we'll kind of juxtapose that with the non-accredited investor. What's the definition of a non-accredited investor? Essentially, the anti-criteria of the accredited investor. Again, their annual income does not exceed $200,000 as an individual, or $300,000 for joint, or their net worth does not exceed $1 million, excluding their primary residence. There's a lot of different terms you may hear for non-accredited investors. We've heard retail investors, we've heard sophisticated investors. There's a few different names that are kind of tossed around for the non-accredited investor status. And honestly, that's the majority of us. But those are really just the two types of primary investor status. And based on your individual status, you can have the opportunity to invest in certain type of investments that may not be available to everyone.
Yeah, thanks. And so for the person who's either the accredited investor or the non-accredited investor, there is still also a due diligence process in analyzing these deals, seeing if it's right for you. And John's going to touch a little bit more on that due diligence before we talk about one of my favorite topics, which is taxes, in which we'll have David jump in.
Thanks, Mark. Appreciate it. So at this point, we kind of led you down the road here about how, you want to set yourself up, what you want to look at, how do you really decide what types of investments that you can potentially invest on as either accredited investor or a sophisticated investor. When we put together our investments, like Dave mentioned, we file an unregistered security with the SEC. And pending the type of investment we have, some of them could be open to our non-accredited investors who are part of the company. And there are others that are only open to accredited investors. So that's the disparity there on the two. But when you get to the point where you know you can invest on certain types of offerings and investments, and you've found the sponsors that really you resonate with from what you're looking for, the asset classes that you're interested in investing on, and then really determining, you know, okay, where do I want to invest? Then you got to say to yourself, okay, now it's time to start digging in on maybe 2 or 3 or 4 sponsors that you've reached out to, you connected with, some deals that you're looking at. And so what we end up doing is the initial stages, again, as we want to make sure that the groups we are going to invest with, that we're very comfortable with them, we know who they are, we know the executive team, we meet with them, we walk their projects, and we want to make sure we do what we call company due diligence on them. We go through and make sure we get some references. We go through some full-scale projects, full-cycle projects, and we do a lot of the heavy lifting up front, because we want to do that before we look at deals. Why? Because if we start looking at deals, you know, and the company doesn't agree to our parameters, or we have a disconnect, we want to get that out in the open ahead of time while we're doing our company level due diligence. So if you're a passive investor, get to learn about that company so you feel comfortable about them. Make sure you're comfortable with the markets, do the demographic reviews, look at the median income, the mean incomes of those areas, what's generating the excitement for those markets. Are there businesses moving there? Has population growth gone well? These are just, again, tip of the iceberg things we're looking at. What's the return structure? How do the returns get paid out? Do you get your money after 2 years if it's a 4-year deal? How do the returns work? So these are all the things you got to think about. You also want to make sure you have a good team. David's an enrolled agent, and so he has the expertise of being a tax professional. He also understands tax code. So when it comes to our business, having David as our CFO is a no-brainer given his expertise and area of focus. Dave, being our Director of Investor Relations, knows how to do due diligence into project level type information. He works with our investors to understand their kind of desires when it comes to the type of investments they're interested in. And he's the person that's communicating. So kind of put our team together, and that's what you want to have. You want to have that team of professionals, whether it's your personal stockbroker or your registered investment advisor, your accountant, all these folks that can help you, because this is a team sport and you got to make sure you know who to bring on board. When you start getting into the due diligence, you want to start looking at the numbers on the deals. You want to make sure that the information that the sponsor sends to you makes sense. And then once it passes that test, you then want to look at the market to make sure that what the sponsor is sending over also marries up to what the market is showing. So we have project due diligence consultants that work with us that do that exact thing. They first make sure that everything they see from the sponsor gets a thumbs up from what the sponsor shares and it all lines up. And then they look at that market to make sure what the market is producing is also in line. And oh, by the way, we're also looking at things as what's our break even? What's the historic down cycles look like? Where do we know we're going to be able to make a profit, where we're going to be able to get the investors back their dollars and their money? Sometimes it's better to get a return of your money than a return on your money in certain situations when you have some things that happen that you don't expect, or but you still plan for, like COVID or recession, a drop in the market. So those are the things you got to look at in your due diligence. Make checklists up. Being in the military, Dave and I, and even David, we make checklists on every project. What are we looking for? What are some of the things? What's the fees the sponsors are assessing? How much are they bringing in on development costs as far as their revenue? So these are all the things you need to pull apart. And again, I'm doing this at the wave top. And again, we're happy to go through more in detail offline, but those are the things you need to think about. Again, you know, I've referenced a lot of this, and a lot of this we do when we're doing our company due diligence. But again, experience is very important. If you're working with a sponsor who's in student housing and they bring a project to you that's in senior living, you may scratch your head and be like, well, wait a minute, you guys have never done that. Your sweet spot and your sandbox is your student housing projects. Why are you doing senior living, or why are you getting into this new, creative, unique asset class that you may have never done before? You want to know the people, not only with the company and the sponsor you're working with, but who are the folks that they're bringing on, their general contractors, their subs, the banks they're working with. Do they have a good relationship with the county? Do they know how to walk the permitting process through the county to get entitlements on lands, to get permits approved, to get approvals from the design boards at the county level? These are all the things that you want to make sure you're comfortable with when working with a sponsor. How have they done on their performance? What have they said they were able to do versus what they actually did? And so what we always like to ask for is when we get a full cycle deal from a sponsor is, hey, here's how you said you were going to do, and here's how you did. And again, we want to see the good deals and the deals that they struggled with, and we want them to walk through that with us. Obviously, financials, we want to make sure that they're in the black and not in the red, and they're performing at profit levels and having revenue. We need to understand the fee structure, and we go into this more in depth, and I'm happy to do it, but there's a category of fees that you should be looking at when a sponsor brings a project to the table from a percentage standpoint. If a certain percentage of standard industry is a 1.5 to 2 and you see 4%, that's something you got to circle and ask that question about. References are key. Who are the banks they work with? Who are the GCs they work with? It takes a lot of time, but these are the kinds of things you want to get from the companies. And then, of course, you want to ask, what's the returns look like? How do I make profits on this? What do I need to talk to my financial advisor, my accountant about when I'm going to have to pay taxes? And then obviously the most important thing after that would be, what are the legal documents that are involved in the deal? What's the operating agreement look like? What are the terms that are going to govern this partnership when I come in and I invest? So those are the big ticket items. Go to the next slide. So one of the things we focus on big time with regards to our engagement and when we're involved in a project is what we call the capital stack. And that's really, how is the money coming into the deal? And we all know that the biggest person on the block, the person batting first in the batting order, is going to be the bank or the debt lender. The debt lender is going to have the largest chunk of the capital stack or the money that's needed to execute the project. Usually a bank lender or a debt funder company that comes in, they're going to fund around 50 to 70% of the cost. And for that largest chunk, they're going to get the most, they're going to get the best benefits, which include a personal guarantee and recourse debt potentially from the sponsor. They're going to get first lien position, meaning if something happens, they can control the property and take it back. And for all of that, they're going to get the lowest return. So they're usually going to get that interest rate type of return and have the largest chunk. The next group in there is typically what's called the preferred equity piece. These are pension funds, REITs, insurance companies that collect large sums of capital for investors. And it's typically publicly traded companies. And they're going to bring to the table the second layer of capital, which could be anywhere from $10 million to $50 million, depending the size of the project. They're typically going to get a mid-range return of, I would say, between 10 to 15%, which is not directly sourced, but it's going to be from their business, so they could take their fees out to then pay the direct returns to the investors from those returns. And they're usually batting second. We typically would see them as either like, mezzanine level or preferred equity or some sort of group that's kind of in the middle there, that they don't get all the benefits that the debt lender gets, and they have a little more risk. So in turn, they're getting a bigger return. And then you get a group like us that comes in for what's called typically general equity. And we are the smallest part typically of that chunk. And for that smallest part, we take on the biggest risk, which in these projects are, you could lose your money, right? But we don't have to take personal guarantees, meaning the banks can't come after us personally or try to take our assets. We don't get any lien positions. So again, the biggest risk is the exposure of your money and the potential of losing a portion of it or all of it. And then also you want to have the developer bringing in money. When we do a project and we bring it to our investors, our executive team is investing with our investors. Well, if I'm bringing in my capital with my team, I want to make sure that the developer is bringing in capital from him and or her and their team to make sure that they're also part of it and they have what we call skin in the game. So that's typically how you see that capital stack. The one that the folks that are batting highest in the order, the banks, are going to be the largest piece with the smallest returns. And then in groups like us, who are the smallest piece, are going to get the largest returns. And we have an example there on the bottom just to give you an idea. That's okay. You can go to the next slide. Again, some of the things, and we've reiterated this, is the location is key. We like markets like Atlanta and Richmond. We like Frederick, Maryland, for reasons that are showing population growth. Frederick, Maryland is the biomed hub of the country. It's where Fort Detrick is, where the research and development is being done for the National Cancer Institute for COVID. So a lot of biometric hubs are there, and there's a need for housing. Atlanta, Georgia, seeing a massive increase in population year over year. They've just surpassed Miami as the largest metropolitan city on the East Coast in population. We see numerous businesses going there. We see a lot of people going there. So when you see those things, people are going to need housing. Those are the markets we typically resonate to. What's the competition? What's coming down there in the surrounding area? If you have housing and you have companies that are opening, what are some of the shopping centers that are opening? Is Best Buy going down there? Is Home Depot going down there? These are the other things you want to look at. And then obviously pulling up periodicals, news articles, researching the Wall Street Journal real estate sections. These are all things that we have such a wealth of information on the internet. It's very easy to access a lot of that. Some of it's paid services, others are free. My favorite's to go onto Google News. I'm not soliciting for Google. I'll go to Google News and type in, Atlanta, Georgia real estate market, and I get fantastic information on there that I can pull further from as I go through. And then obviously, you want to make sure that when you're going through and you're looking at your returns analysis on a deal, that you understand what the risk is. We really pride ourselves more on protecting our investors' money than showcasing the fantastic returns, which we know we can hit if things hit as we underwrite them. But investors really like to know, how are you going to protect my money, and see that analysis. So next slide. So Mark, back over to you, to our tax expert.
Yes, perfect. And we did have a couple questions come in. We will get to those at the end of the section. Very excited to now touch on the tax considerations, because as one of our previous guests had put it, most people use about 2 pages out of the 80,000 pages of tax code, and it's important to know how to leverage them to build your wealth. So David, can you start going into the different types of taxable income, and really why this matters to the investor?
Thanks, Mark. Be happy to. So in the different periods of time that you're owning passive real estate, there's going to be different tax considerations. If you're going to own rental real estate, that's considered passive income, and there is a specific tax law for passive income. Depending on your income level, you may not be able to deduct passive losses, and passive income is usually set against passive losses. And how that treats an individual on their personal tax return is a little bit subject to the amount of income that person or that couple has on their tax return. In the long run, obviously, with real estate, at some point you're going to sell it and you're hoping for gains there, and you run into long-term capital gains. Could be short-term capital gains of less than a year, but most times it's long-term capital gains. There are favorable tax rates for long-term capital gains, and in certain cases, capital gains can be lower or even 0% tax rates. I'll go into that in a little bit as well. Like I said, if you have a property that you buy and sell in less than a year, you're going to run into ordinary income rates, which is your highest interest or highest tax rate. So that's something to keep in mind if you're flipping a project, and the ability to hold that project for that 1 year mark or later may have significant advantages for lower taxes to keep it for that 1 year. And over time, you're also going to be getting your own money back. As, you know, in some of our projects, we will invest in a project to possibly develop a project, develop a building, build the building. And once it's built, once we have tenants in it, we may do a refinance or recapitalization of the debt that is in the project from the bank, and it's possible and probable to get some of that return of capital back. Good part about that is you're receiving your own money back, so you don't have to worry about paying any taxes on that. Over the course of the project, if anything other than land, you will have depreciation. That depreciation on the property itself and also furniture, fixtures, and equipment become a tax deduction for the investor, and that flows through to the investor, and they're able to deduct that off of some of their other incomes. I'm making this pretty short. I could do a whole week on this page, so I'm trying to just hit the main points. Most of your passive investing is going to come through either a partnership or an S corporation. Both of those entities, the way they report income to their investors is through a K-1 statement. At the end of the tax year, you'll get a K-1 statement, and it just gives your portion of the income and deductions, possible tax credits, and some other information. And that comes to you, and you'll use that to prepare your tax return. For some of our projects, if we're getting just interest, if we're loaning money to a developer, we might, then we would get interest from them, and you would receive a 1099 INT showing your portion of the interest that you had earned during that year and collected. The federal and the states have their own tax laws. There's lots of different brackets for that. Some states have no tax, income tax, so that becomes more beneficial. There's less than a dozen of those, but that can definitely be advantageous. When we're doing an investment, some of our investors have to be aware that if you're living in one state and we're investing in a project in another state, it's possible that you'll have to pay tax, income tax, on the project because it's taking place in another state, and that state wants their income revenue. There are some ways to do tax deferred or tax-free investing. I've mentioned a couple here. Opportunity Zone was created in the 2017 Tax Act, which allows for investment in certain areas that are designated by each of the states as needing capital for resurgence. And if you invest in those areas, then there are tax advantages, tax deferment, and tax-free benefits. If you want more information on that, again, you can go on to the internet and find out more, or contact us. A 1031 exchange is when you sell a property, you have a gain with that property, and you roll that gain into another property. Typically, you have to take the entire amount of your gain to get your entire deferral, and then you don't have to pay tax on that until the next property is sold, unless you do a 1031 from that to your next property. So quick rundown of all the different tax topics. So all of our investors are all concerned with taxes. Taxes are the number one highest expense that anybody has in their life. So definitely want to understand the different tax implications of the different types of investments that you're getting into. And hope you become a JID investor if you're not, and we can give you more information.
Yeah, and I did have one question that I think would be good to, it came in, I think it'd be good to touch on before moving on, which would be, someone asked if the passive income is taxed as, as W-2 income, or if it would be taxed more like long-term capital gains.
So W-2 income is income from earnings, active earnings as an employee. So that would not be how it would be considered. The passive income comes into your tax return, and you pay taxes on that. Again, probably through a K-1 statement, but having nothing to do with wages or employment taxes or Social Security taxes or anything like that.
Perfect. And that's also why we highly recommend having a stellar CPA. I know we've had a CPA on before, but that's also a good person to have in your quiver or your arsenal, if you will. And then lastly, before moving on, with the Opportunity Zone, that is something that Josh and I have really stressed on people inquiring or asking questions on them. It's really important to get a good guide in the Opportunity Zone world, because the existence of a project within an Opportunity Zone classification does not automatically make it a great investment, right? And some people say, hey, I found an Opportunity Zone. It's like, and I'm not the one to say whether it's good or bad. We just always stress like, hey, it really gets, it's good to get some good guidance and make sure that you found both an Opportunity Zone and a good option to move your funds into. So on that, we will shift over to back to John to do a quick case study on some projects that you guys have had.
Absolutely, I'd be happy to go to the next slide. So yeah, we're going to kind of talk about a case study we did a couple of years back where you did a project in DC. And so just want to use some figures and go through it from how we put it together and show kind of how this all comes together, whether you're going to invest in something like this passively or you join a company like ours that would bring this type of opportunity. This is in a really great area of Washington, D.C. that's seen some great growth over the several years. DC is a fantastic market. It brings the government, obviously, as a huge or number one tenant, anchor tenant. We also had announcements of Amazon HQ2, which is in now year 2 of its transition as the second headquarters here on the East Coast. Government contracting, Fairfax, Arlington County is the richest county in Virginia, and is one of the richest counties in the country, as well as Fairfax County as well, where we are. So it's just very much primed for great investment in real estate. This was a typical ground up new construction type project we had in a very great really good neighborhood of the DC market. And the sponsor was someone we were working with for quite some time. I believe this is either our 9th or 10th project we had teamed up on together. And the goal was to put up a number of condominium properties and to sell the property. So you can see the column there. That's kind of the going in argument of what we had on paper and how we planned on going into that project. And you can see on the left-hand side, the sponsor is basically running with permitting, getting approvals for the zoning, the construction, and going out and getting the necessary debt financing and the funding for the project. Again, that top layer of funding that's needed, the largest piece of the capital stack. We elected to bring in about $1.3 million of equity to this project, and the sponsor is bringing 1.3, and we were bringing in a little over 1.5 million. So you can see that the sponsor had almost the same amount of what we were bringing in. Our kind of litmus test on this is we want to see the sponsor bringing in at least 10% of our equity to the project, and or the potential of the overall equity that's needed for the project as well. And the sponsor was basically in charge of operations, marketing and advertising, listing the property, and ensuring that it stayed on timeline. Our job was to work with the sponsor to get the information, the project updates, and to keep those investors who are participating on this project informed. One of the neat things we like to do too, and we did this several times, was taking our investors out to the site, meeting with the sponsor and his teams, walking the project. It's really neat to have, you know, your money working for you and then being able to go out and see it firsthand as it's growing into this amazing property. On the right side, you'll see some of the actuals. We started on the same time. Costs escalated a bit, which was expected. Usually those are absorbed through contingencies. So you always want to make sure you see a contingency cost on the breakout in costs when a sponsor sends you their pricing. And then especially now with the way things are escalating in price, we typically like to see about a 10% contingency, but now we're starting to see more like 20%, just to over compensate for the increases to cost from labor shortage, from property costs going up on material, as well as supply chain challenges and inflation. The market appreciated very nicely during the duration, around 7-8% on average, which is really nice. We saw those sales numbers kind of climb a bit, so that offset the cost as well, and also helped with our profit numbers. We also had a segment of affordable property in DC. It's usually about 10% of the market rate or total number have to be in what's called an inclusionary zone, IZ affordable housing. So those units usually go for significantly less. So again, that's something you want to look at when you get into a project that has those types of regulations and have those type of requirements when it comes to sales. Parking spaces kind of escalated a bit as well. Typically they were selling for between 35 to 40K. And the total project revenue saw a nice bump up, about $1 to $2 to $3 million of additional profits there, which was great. We did go out a bit longer than expected on the closeout, but when we saw our targeted versus actual returns, we were very pleased with this project. And these are the things you have to expect. These things happen. You have weather delays, permitting delays, COVID delays. These are all the things that you need to anticipate and have answers for when you talk to your investors. And you should be asking your sponsors as well when you go through these types of projects. Go ahead and go to the next slide.
Just a second here, sorry.
No worries, take your time.
Got it on the wrong slide. There we go.
So the way we set it up is we collectively bring in the total amount of an investment from that's requested of us. And what we do is we go out and raise that in segments to our investors. Usually we call them, an investor amount. We usually go out and raise that, and we do shares or we do a number of units, investment units that we break out. So for example, if we're going to go raise $3 million for general equity on a specific project, we'll go out to the investors and we'll raise 100 units of investment at $30,000 a unit, which means the minimum investment is $30,000. But if you want to do 10 at 300,000, or you want to do 15 at 450, that's available as well. David and I and Dave and our executive team typically come in for 1 to 2 units each, or total, depending on the scenario, maybe more. And then we bring that total in through the business. We do our legal documents, and then that money then dovetails in under a single purpose vehicle to invest on the project, typically as a limited partner or as a co-general partner in the deal. So we have ownership as a partner in that ownership entity that has control of the project. In this investment, we raised $36,150. And that number was calculated by David. So we went with that, and that was the number that made it work for the total number that we had to raise. The typical number we usually strive for on the capital is about 25 to 50,000 on any given project, and that's typically the range we stay in. We offered the investors a deferred or accrued return of 12% return. So for every year that project went, the investors were going to get the first 12% return on their money. And that was going to be paid to them before our company would take any profits or realize any revenue from the deal. So that's something we put in place to give the investors a nice, healthy preferred rate or preferred return, so that they feel confident that their investment is going to be ideal. And when you go through our waterfall or our distribution schedule, the goal really is to shoot to get the investors around a 15 to 20% return. But that first 12% is going to go to the investors. And that's where I say there in the third bullet, the subset bullet there, we typically split profits that remain after the 12% pref, and our company gets our revenue 60-40 or 65-40, 35 rather, in favor of the investors. And that's where they hit those targeted returns. If there were sales that were higher than projected, so let's say we did better, then obviously our returns would be higher as well in those scenarios. All closing fees, broker fees, any type of fees that are associated with sales and closings were taken care of and were the responsibility of the sponsor. And then any cost overruns, which is something very important as well, were covered by the sponsor. You want to make sure that there's additional capital that's needed. The sponsor's not going to come to you. They're going to bring in the money themselves or reach out to other groups to make sure they get what they need. And go to the next slide. So yeah, the project was a great success. It was a wonderful project to add to our portfolio and from our completed projects. A little bit of an extension due to some inclement weather and some permitting issues. Go figure, in Washington, D.C. having permitting issues. It's a very high regulatory area. So that's why it's important to have a good sponsor that can walk through that. Our company made a total project, or the total project profit was about $2.1 million. And our side of the net profits was about $360,000, which got our investors that 12% preferred return. And it also got them an additional 3.3% year over year to get them a 15.3% total return year over year for their investment. So on that $36,150 over the 18-month period of the investment, the investors made 15.3 year over year. So a little bit over, David will help me with this, around 23-24% total investor return. Next slide. That, I believe, is it. So we appreciate it again for your time. And Mark, I guess we can open it up for questions and our team can jump on that and do our best to answer them.
Yeah, I'll unmute myself there. All right. Yeah, so first question that came in was, so considering the past and current investments that you guys have going right now, what's generally the split that goes strictly for accredited investors versus open to non-accredited investors?
Yeah, it's a good question. So Dave talked a little bit about the SEC requirements and how we kind of stipulate those as being having folks coming in as an accredited versus a non-accredited sophisticated retail investor. The SEC has different types of filings that they require, and the ones we typically go with are the Form D-506B or the Form D-506C. So the 506B allows an unlimited number of accredited investors, and it allows up to 35 non-accredited investors. So as long as we have 35 or less non-accredited on a B, as in Bravo, we're allowed to have as many accredited investors as we want on that type of investment. And we typically work with the sponsor to determine the risk levels to see whether or not we want to have the investment as a B or a C. Sometimes the sponsors require only accredited investors, in which point we would do what's called a 506C, which is open only to accredited investors. Okay. So I hope that answers your question.
And that kind of fits, that kind of tees up the next question that did come in, which was, where can someone go if they're not an accredited investor to go look for postings or something for non-accredited investors that fit within the syndication?
Another good question. So, there's certain requirements and legalities you have to follow. For a 506B, you cannot generally solicit. So I can't go on LinkedIn and start listing all this great information about this 506B I have. That's against the law. So one of the things that you have to be careful of is that if a sponsor is advertising a 506B, stay away from that, just because it's not supposed to happen. Some of the deals that you can go and find 506B type offerings are on things like crowdfunding websites, which permit that after you join up and become a member and you go through their requirements of filling in the necessary income levels and information that would delineate you to potentially be a sophisticated investor. And those are the places that you would find those types of investments.
Okay. Now on the profitability side, we had another person say, with the rising interest rates, how is that impacting that 12% preferred return?
Good question. David, you want to take that one? Or Dave, or both?
Sure, I can take it. So the interest rates that are going up are definitely going to make the cost of money a little bit more expensive for these projects. And that's, something that we definitely have to look at. As for our 12%, we plan on keeping our 12%, which we think is an extremely high preferred rate for our investors at that level. If interest rates go absolutely wacko and we go back to the 1970s, then we'll, might have to adjust that. But I don't think the interest rates where they were and where I think they're going to be going will affect our ability to still allow for that 12% preferred rate to our investors.
Yeah,
And I'll kind of jump in here too, real
go ahead,
quick,
Dave.
Don. And that kind of circles back to John's earlier point on the importance of underwriting and due diligence. If you underwrite a project with certain assumptions, and if you're looking at current interest rates at 3.5% to 4%, and you're going to bank debt, and you're going to underwrite that project with an assumption of maybe 4 or 4.25%, you have a little bit of built-in security there. So when you're looking at the individual sponsor, you're looking at the individual project. If you underwrite it, realizing the market interest rates may go up, we may have, supply chain issues, or we may have, supply cost increases and things like that. You factor that in your original due diligence and your original underwriting, you can still realistically offer that 12% preferred return to your investors, knowing that you've underwritten for them.
Yeah, great point. And that's what we're typically doing now on our deals, is we're really looking for a conservative interest rate when we underwrite, because some of these projects they're long-term projects, 3-4 years. So we want to make sure it has a conservative underwriting interest rate.
Yeah. And someone else asked if that 36,000 number that you put out there in that case study, is that the typical entry point for the real estate syndication deals?
I can only speak for our company. That's kind of where we are. We like to have a nice entry point. We want to have investors that have the opportunity to get involved in a project at a lower entry. There are companies out there that require 100,000, 150, 200 higher as a minimum investment. We want to maximize participation, because we want to have folks be able to take the opportunity to invest in these types of projects. So that's why we're typically around 25 to 50,000 in that range. You could always do more than that, but it's nice to have that someone who says, hey, I'd like to come in and just do one unit at 30,000 and see how it goes, and then maybe I open the aperture to do more.
Perfect. And then I had a kind of a blunt question come in where someone asked earlier on, if the project burns to the ground, what happens to the money?
That's a good question. Well, first off, these properties, if there's nothing there, obviously there's no type of, homeowners or builders risk insurance. But that's something that you have to go through with the sponsor. You have to look at things like natural acts or acts of God that you can't control. Those are all in. We put those in our private placement memorandum packages as risks. And so people know that going in, that's a potential risk. And yeah, we have to be able to explain that, whether it's the fact that if there's something there and it gets burnt down, maybe there is insurance that covers it. But yeah, that's a great question. David, anything you want to add to that I might be missing?
Well, yeah, a little bit. I think that any real estate investing that somebody's going to do, there's, especially from a developmental standpoint, there's always that risk for complete loss. When you're buying existing properties, that risk isn't as high. Buying an existing multifamily house or multifamily apartment that has tenants, the risk of losing all your money is very, very small there. But you're also receiving returns that are much lower because that lack of risk. We like where where we are, especially with some of our development projects, because even though those inherently have more risk, I believe that we do a really good job of our due diligence to vet out the best people to work with, and we put our money at risk as well of our investors. As John mentioned before, John and I invest in every one of our projects, our own monies. If it's not good enough for putting in our own monies, we're not going to ask other people to do it. Depending on what type of real estate or investment you're getting into, has a higher level of risk and a higher level to lose more money or not lose more money.
Perfect. Yeah, and just with I've said this a couple times, but having that team together and getting that good education and guidance, obviously there's rules set in place, especially with the accredited investors versus non-accredited investors, to keep people from dumping their entire net worth into a project, right? And mitigate those, but definitely get good counsel. Get how you feel about your money better than anyone else. So get some good education, and absolutely make your own assessment.
Well, folks, that's all the time we have for today's webinar. I want to thank everyone for being here. What an interesting and informative presentation we've had. Thank you so much to our attendees for attending, and look to your email for a replay of this recording soon. And you're welcome to share that with friends and family who'd like to learn about this topic. Here at Advice Chaser, we're all about helping you find an advisor who's a great fit for your life and your financial questions. Every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming. We will see you at another webinar soon. Goodbye, everyone.
Thank you.
Thank you.